Welcome, 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 everyone. Welcome to the first holiday call. I get to be the first one to kick off the holiday season with our MAPS coaching holiday call, and you are here to learn a little bit more about profit optimization for teams. I see some familiar faces on here, so appreciate the opportunity to be with you today. We're going to be here for the next 5 hours. Just kidding. We're going to be here for the next 45 minutes to 50 minutes. The staff was like going crazy when I said 5 hours. And we'll wrap up probably about 10 minutes before the hour. And then what we'll do, everyone, is we'll open up the floor for questions that you may have. I will be monitoring the chat as we go. So it's right over here. So if I do look away, if you have some questions along the way, please feel free to put them in the chat. Otherwise, you can come off of mute towards the end, and then we can ask some questions and answer any of those questions that you may have. So this is going to be a really powerful session, everyone. We're going to talk money. There's going to be several things that we're going to work through today, and I'll start to kick things off with who I am and what I am. But we're going to really talk about some money, especially for teams, and some profit leaks that I see within organizations and teams. We're going to talk a little bit about why businesses fail, and we're going to open up things for the budget model. So we're going to talk a little bit about the budget model. So this will be a nice 45-minute to 50-minute action-packed item around money, financials, and teams, and I'll give you some examples of what to do and what not to do. So appreciate the opportunity to be here with you today. For those that don't know me, my name is Kyle Harrison. At some point, I think I should be able to click this. Let's see here. For some reason, this is not working. Hold on a second here. Can everybody see my screen here? Yeah, let's kick that off. Let's see. There we go. All right, so we're in business here. Just so you guys remember the Telephone Consumer Protection Act, TCPA, the do's and don'ts of that, and please make sure that you're following the do not call list. You can get in some pretty serious troubles. I believe you all have heard this. For some reason, if you're on the screen and have not heard this, make sure you're pulling up the laws on do not call lists and really protecting yourself and making sure that the people that you do call are allowing you to be able to call them. So really follow that as well. For those that don't know me, my name is Kyle Harrison, everyone. I'm an executive coach with MAPS. Been an agent, a Keller Williams agent, a little over 19 years. And I just have over 10,000 coaching calls. And my specialty of coaching is leadership, team building, financials, and wealth, and helping agents with a buy strategy, which is build your exit strategies. A lot of that is around financials and wealth. So obviously I'm here talking about profit today because I'm super passionate about it. Numbers is my love language. So really appreciate the opportunity for you being here. I am CEO and owner of Your Bookkeeping Partner, which is a very specialized MREA bookkeeping, payroll, and tax company. So this is what we do. This is the only thing that we do. And as Jay Papasan says in the one thing, that this is our one thing that we do. So we only work with real estate agents like yourself in this bookkeeping, payroll, and tax space. I am an active investor, just a little over 300 doors throughout the Midwest and Southern regions. And I built a lot of those doors through creative financing. So I do a lot of teaching around how agents can build wealth without using their own money. And I'm super passionate about being able to help with that. If I get anything right in this lifetime, it'll be being a great dad to these two beautiful girls. They're 21 and 19, and those that have kids on the screen, they grow up fast. And so this is my purpose. This is my why. This is why I wake up and get the opportunity to do what I do for them every single day. All right. My mission statement, I like to share this just so you know why I do this. And I do a lot of speaking, a lot of teaching, a lot of coaching, is to empower real estate agents to financial freedom. And I think real estate is a great industry where most millionaires and billionaires are created. And so we help investors build wealth. Why are we not doing it ourselves? And really the first step to empowering real estate agents to financial freedom is to really understand your money. So I hope for today, you walk away with a little bit of understanding of your business, of your money, some profit leaks in your business, and of course, ask some questions along the way. All right, so here's what we're going to cover today, everybody. We're going to talk a little bit about the MREA budget model, what it is and what it is not. So that's going to be an important piece. Gary Keller in the MREA, or the Millionaire Real Estate Agent book, gives us a great model to follow along. And we're going to talk a little bit about what it is and what it is not. I'm going to just give you some highlights to pay attention to on how to use this really effective model. We're going to talk about the difference between an accountant P&L and a business profit and loss or P&L as well. We're just going to give you a little bit of an overview of what that is and why it's different and what accountants will say. And I'm going to give you an examples along the way. We're going to talk about the cost of sale. This is for teams in particular. So if you are a team on here, pay attention when we talk about cost of sale. If you're a single agent or a solo agent on here, pay attention if you want to grow a team. So this cost of sale really impacts your profitability. And so we're going to pull up a P&L and we're actually just going to show you some of the cost of sales that go along with that. Lastly, we're going to talk about some KPIs. On the P&L, I've got 5 KPIs that we're going to work through. And KPIs means key performance indicators. So whether you have a profit and loss or you don't, that is okay. I'd much rather prefer you have one. However, if you do not, that's okay. But these 5 KPIs, if you can really focus on that and pay attention to that, you're ahead of a lot of realtors in the industry and you can start making smarter business decisions. And lastly, I'm going to give you some bonus tips, tax tips. Now, I am not a CPA or an accountant. I'm just going to give you some tax tips along the way as we're working through the P&L. However, any tax tips or any advice that's on here, please make sure you run it past your CPA and your accountant. I just know enough to be dangerous. I know enough some very fundamental tax tips that you as agents can write off. If you're making higher income, you're looking to have some tax write-offs as well, and I'll give you some of those tips along the way. All right, some of the things that businesses fail and why I look at the businesses is really the top 3 here is poor cash flow is number 1, poor cash flow management. And that's really about your pipeline. That's about understanding your pending commissions and really being able to forecast what your business is doing and how much money you're making. A really good indicator now that we're the last month of Q4, heading into Q1, if you have a profit and loss or you've been tracking your profit and loss, look back and look at the first several months of what January, February, and March were of this year. You can start to pay attention to that because that's probably what your P&L or profit and loss is going to be the first quarter of next year. So that's a good way to start understanding any big expenditures that are potentially coming up that would hit your expense line. Losing control of finances, that's why you're on here to get a little bit better. Kudos to you, high five to lean into this. Finances can sometimes be tough to talk about because we may not understand it completely. However, the more you get into it, the more you understand it, the better business decisions that you're going to be able to make. And so you'll start taking control and empowering yourself in the finances. Bad planning and lack of strategy. So when you're looking at your profit and losses or you're looking at your financial statements, this is a good way to be able to start planning for what next year is looking like. Anything that you're reinvesting back into your business, you want to create an ROI, a return on investment for your business, and be able to plan. I look at financials really in 3 things as you're driving a car. If you're driving a car, you have your rear view mirror, you have your dashboard, and then you have your dash or your windshield that you're looking down the road to being able to see where the next turn is. The rear view mirror, everybody, is your profit and loss. It's what's behind you. It's what things that have been spent. It's maybe some habits, good habits or bad habits that are behind you, and being able to learn from what you've actually spent. So that would be the rear view mirror would be your profit and loss. The dashboard would basically be your budget. Like if you can get to a point where you understand your profit and loss, and now you're starting to work through your budget, the budget model is a great tool for that. However, being able to now tell your money where to go is very empowering. And the last thing is looking down the road. That's really your cash flow analysis or your cash flow management. So if you can get your business to a point where you're at cash flow management, you're doing very, very well as a team. So you can understand your P&L, you can tell your money where it goes in the budgeting, and then for cash flow analysis, look downfield. You're sitting in a great spot with your business financials. So really for today, everybody, I really want you to take off your realtor hat, put on your CEO hat, and we're going to look through the lens of a business owner. And then number 4 is weak leadership. We've all had weak leaderships in our lives. That's another way of businesses failing. And the last one is just over dependency on few big customers. For example, if all your eggs are in one basket and you're not diversified in some of your clientele, you could potentially get in trouble that way. So those are the 5 things for that. I want you to write this down, everybody. If you want to grow your money, you have to know your money. At the end of the day, If you do not have a relationship with your money and you do not know your money, chances are it's going to be a tough road for you in the real estate business. So really, if you want to grow it, you got to know it. This particular point of understanding it and knowing gives you the ability to make business decisions and gives you the ability to make business choices along the way. And so P&L is really your profit and loss is your first step, budgeting, and then of course cash flow. All I say is get to know your business, everybody. This is or get to know your money. There's a couple books that are really good that I like to recommend. It's a really powerful book with your relationship with money. Number one is The Psychology of Money by Morgan Housel, a fantastic book. I read this book at least once a year just to keep me centered around money and understanding money. The second book that I like to recommend is Rich Dad, Poor Dad by Robert Kiyosaki. Those are two really good books to really start to understand and get in the mindset of understanding your money and growing your money. So Rich Dad, Poor Dad, Psychology of Money are two fantastic books to start having a relationship with your money. All right, this is the MREA budget model, everyone. If this is you or is not you on here, this is just out of curiosity. I'd love to get some feedback here. Who has actually seen this statement or this budget model? Just put in the chat. Just put yes, no, maybe. If you would, please. Yes. Okay, Barbara. Thank you, Faith. Yep. Okay, perfect. Okay, great. So we've got a lot of yeses on here that have seen this. Now, the next question is no. I see a couple no's. So thank you for being honest and vulnerable here. This is how we learn and get better at that. Now, the follow-up question is who knows how to use it? That becomes the set, and you don't have to answer that as well. But I get a lot of this. I've seen hundreds, if not thousands, of profit and losses, everybody. And this is a really fantastic tool to be able to use in your businesses. And what we're going to do is, if you see the numbers on the left, 1, 2, and 3, I've just basically blown that up on the next slide. So we're going to work through that individually. I won't spend a lot of time here. However, I really want you to understand the concept. Now, what I'm going to do when I pull up an actual sample P&L, we're going to be in the $1 million. If you look at the $1 million best practices over the right, we're going to work through that column right there, all the way down to insurance and automobile and equipment and furnishes. But here's how you use this, everybody. You see over on the left-hand side is GCI, cost of sale, gross profit and expenses, net income. We're at the top left there. And at the very top, you see the GCI 150 all the way across the board to 250. So how you use this model, everyone, is pick your GCI that you either have created last year's GCI, or it's because we're part of the end of the year, use this year's GCI. And when you look at your GCI, match that up with this particular budget model. So for example, if you made $340,000 last year, you would use that column of under 340. So the average of all the P&Ls that Gary put together that made the MREA would be 26%. Gross profit would be 74%, expenses 36%, net income 38%. This is not the end all be all. This is just the averages and the best practices. So then you can compare how your business lines up with the other businesses in the real estate industry. Then you, as 340 GCI, you just work your way down all the way down this column under compensation over on the left-hand side, which is 11.1. You can see right there on the middle of the screen at under 340. Lead gen would be 10.2. Occupancy, education, and coaching, and you can work your way down to insurance. Now, here's where people get mistaken. They think they have to hit every number. We're agents, we're competitive. And so I get the fact that you want to hit every single number in your specific category. However, if you're happy with your net income, high five, good for you. And you're outside of model, that is okay. If you are not happy with your income or not happy with your profit, this model becomes very helpful for you to see where you potentially need to dial things in. And we're going to talk a little bit about that here in just a few minutes about that. So for today's sample, everybody, we're going to stay in the $1 million mark. And there's some numbers I want you to write down because we're going to pay attention as we pull up the P&L and we walk through this. I'm going to be referencing some of these numbers. So here's the first number, cost of sale, 25%, under the $1 million column here, if you look at the very top, I want you to write 25% down cost of sale or COS. The second number I'd like for you to write down is expenses, 36%. Okay. The third number I would like for you to write down is under compensation, is 20%. The fourth number is under lead gen, which is 7.3% down here, right about the middle of your screen here. So you should have four numbers on your page, and we're going to work through that as we look through the sample P&L, and we're going to be referencing these numbers based off the P&L that I'm going to show you in front of that. So for those that don't understand it and you would like to learn a little bit more, please feel free to reach out to me. Please feel free to reach out to your maps coach and really help understand this. This can be a great and powerful tool. And it also helps as you're growing the business and your income starts to grow where you should be percentage wise. So it really helps you stay in center and true to your net profit. All right. So here's the first part. It's just a blow up. Again, it's just being able to see the top version. This is the 10,000 foot view of where you potentially need to be. So if you're at a 340, you should be at 26, 74, etc. If you're at a million, you should be at 25, 75, 36, 39. Excuse me. Just getting over a little bit of a cold here. It's going around. If you are at a 500,000, or you're in a number in between, let's say 750 or 500,000, or maybe you're at 2 or 250, you want to take the averages of the two and just split it right down the middle. For example, if you are at $500,000 in GCI, just take 26 and 33, split it down the middle, it'll be about 30%. So if you're at a 500,000 GCI, your cost of sale, you will want to be around that 30%. Gross profit, you'd want to be around that 70% and just kind of work your way through that. Okay, makes sense? All right, I think we get some questions here. Okay, looks like we're getting some answers there. Okay, the 4 percentages. Okay, got it. I think we've got that. All right. So this is that. So part two is just more about compensation and lead gen, where you need to be. Cost of sales is a big profit leak, and we're going to talk a little bit about compensation and lead gen. Really pay attention to that. This is where your biggest expenditure in your business is. However, the caveat, everybody, is compensation and lead gen really is an investment. I know on your profit and loss, it shows up at an expense. However, we're reinvesting back into people for compensation, and we're reinvesting back into lead gen for our business to generate more business. So we really want to look at that. Under the compensation and lead gen, you want at least a 4-to-1 return. And what that means is for every dollar that you invest, you want at least $4 in return. Okay, so I know compensation can be a little hard, especially if you have staffing. However, that is something that you want to pay attention to, is how much time you're actually getting back when you're hiring someone for your business. Lead gen, it should be pretty easy. We invest something, we get leads, or we are able to close, or we're able to convert. We should be able, as long as you're tracking those leads and where they're coming in from, that should be a pretty good indicator. Are you at least getting a 4-to-1 return? Lastly, everybody, it's really the other 7 categories here. So compensation, lead gens 1 and 2. The other 7 categories are right here: occupancy, education and coaching, supplies, communication. Work your way all the way down to insurance. Now, there is some expenses out there that you probably don't know what category they would fall in. If for some reason you don't know what the category that they would fall in, they would fall under lead gen. Just park them under lead gen. If it's a category you just don't know, just park that right under lead gen. So get familiar with this, everybody. This document can really be your friend as long as you're tracking it at a certain level of your business and being able to use this document accordingly. This should be able to give you that centering balance of where you are with the rest of the industry. Okay. All right. We're going to talk a little bit about the difference between an MREA business profit and loss and an accountant profit and loss. Okay, so the next 2 slides are going to be focused on that. So as you can see, we've been spending the last 5-10 minutes or so on the budget model. And so we've been paying attention to those 5 categories: GCI, cost of sale, gross profit, expenses, and NOI, net operating income. When you have QuickBooks, and I'm not going to go down the rabbit hole of QuickBooks, but when you have QuickBooks will plug into your checking account and will plug into your credit card account. It'll pull that data in, and you can actually start to categorize those things. Now, gross profit, everybody, is the actual commission check that you receive. So when you receive that commission check from your office and you deposit that into the checking account, that is what we call gross profit. Okay. And then as we start to categorize your expenses, obviously we want to make sure that it falls underneath those 9 categories. Voila, you can have a net operating income. This all gets pulled in from your business accounts. Now, what does not get pulled in, I'll repeat, does not get pulled in to your QuickBooks is GCI or cost of sale. Now, I'm going to assume majority of us on here are Keller Williams. These numbers comes from your DA, your disbursement authorization. This is you get two documents with every commission check, a summary, and then you get a detailed of what came out of your check. Okay. If you have not started paying attention to those, now is the time to start doing this. So you want to start tracking your GCI, especially you teams on here, and that's what we're doing, optimization, profit on teams. You want to start paying attention to your GCI, what's coming out of that check, and we're going to talk about cost of sale here in just a minute, and then what's the actual check that you receive and the expenses and then NOI. Now, let me give you an example just to start to put this into a bow and start to bring this home. You have a closing, and let's say your GCI for that closing is $10,000. The money that comes out, which is cost of sale, let's say, for example, it's $2,000. Your commission check or your gross profit is $8,000. Okay. So in the MREA, you have to track the GCI, the cost of sale, the gross profit expenses to arrive to your net operating income. That's all those percentages are based off of GCI. Okay. Accountant profit and loss is everything besides the GCI and the cost of sale. I call this an accountant profit and loss because this is all they need, everybody, to do your taxes. This is all they need. And they're right. I've had arguments with accountants. Well, my client doesn't need to see the GCI and the cost of sale. You're right. However, I asked you to take off your realtor hat today and put on your CEO hat. If you want to have a CEO hat and look at the budget model and run your business as a business the way it is to the MREA, you're going to have to track the GCI and the cost of sale. Now, for you solo agents on here, you don't necessarily have to track the GCI and cost of sale. If you want to build a team or have a team, or you're starting to get into admin or maybe a showing assistant or a buyer's agent, you absolutely want to start having the best business practices for an MREA budget model P&L. However, if you're just wanting to use your profit and loss for tax purposes, this is all you need. It really is all you need. I bring this up, everybody, because I get the opportunity to talk to hundreds, sometimes maybe even thousands of agents. And even leadership is not understanding the difference between the two. I was on a phone call several months ago with a leader. I'm not going to obviously name names. They said, well, I have an MREA budget model P&L. I said, great. How do you pull your DAs? They're like, I don't. Well, then you don't have an MREA business model P&L. You have an accountant P&L, because the only way you can have one is if you're pulling your DAs and you're actually categorizing them on your QuickBooks or your profit and loss. So just understand the concept of this, everyone. So when you're looking at your P&L, are you looking at the percentages from a GCI standpoint, or are you looking at the percentages from a gross profit standpoint? And as you can imagine, they could be vastly different. Okay. All right. Shawnee, we're going to get to that. Some professional services with the team. Yep. We'll get to that here in a second, looking at some of the questions. How do you account for personal income? Michaela, we're going to talk about that here in a second. That's what we call below the line. We're going to get into the P&L here. I think, okay, got it. I think I've got the questions answered over here. So please, everyone, understand this. If you don't understand it, please feel free to reach out to me. I'm happy to work through this, but at least understand the difference between the two as you're starting to look at your business. Everyone, I hate to say this, is coming right to you, right between the eyes here. If you're not tracking your income, expenses, and net worth, you're not even in the game. And that's just a flat on honesty. If you're just selling real estate, living from paycheck to paycheck, or you're just really focused on the percentages that you make per closing, you're not even in the game. So I just encourage you to start somewhere, start tracking your income, understand your expenses, and really you want to start playing the long game, start tracking your net worth, building a 5-year plan. How are you going to be able to exit this business at some point? All right. Now we're going to get into the profit and loss, and we're going to start working through the KPIs. We have about another 10, 15, 20 minutes, somewhere around there, and then we'll start open things up for questions that you may have along the way. This KPI is one of the biggest reasons, and it's not necessarily for the dollar figure. Obviously, you can look down here, 1,033,000. We're using the $1 million MREA budget model category. However, when people look at this, the first thing that they go to is the income or the gross or the total income I hear at the bottom. What I want you to pay attention to, everybody, is the numbers on the right-hand side. 55.2% and 42.34%. As you can see, seller income on this sample P&L is 55.2%. So they're getting 55.2% of their income or revenue from listings. Same with buyers. Sales income is actually buyer income on this. So 42.34% of their revenue is coming from their buyer income. Now, here's the question. Now, I'm going to open this floor up. Why is that important? Why is it understanding this important? Love to put in the chat. Why is this important? Why are these two numbers important in your business to know? Any thoughts? Nurture those two items. Okay. So you know where you're getting your business from. Love that, Joe. Exactly. Yep. Buyers on listing, you should get two more buyers. Yep. Leads, listings, and leverage. Love it. Perfect. You guys are where to spend investment. Love it. Great job, team. All right. That is exactly right, everybody. There's this wonderful model called the 3 Ls. It's leads, listings, and leverage. It does not say leads, buyers, and leverage. It says leads, listings, and leverage. So when your business is above 50% of your income coming in from sellers, you have a very stable business. The goal is to get it to 60%. So 60% listing income, 40% buyer income, right? You have a very solid, stable business. Now, for you buyers agents on here, that would be different than you, okay? So this is just the rainmaker looking at it through the lens of a CEO here, okay? Now, 60-40 is where you'd like to be. 50-50 is where you really the minimum of where you want to be. It's a very stable business. Imagine if your business was flip-flopped, and let's say your business was 70% buyer income and 30% seller income. You can imagine, we're all smart people on here. We're in the professional business. You have MAPS coaches, right? Your business is unstable. We just work harder and make less if we're working with more buyers. We just understand that. They take more time to be able to close, and there's just more energy to be able to show and work with buyers. You buyers on this, again, buyers agents on this, earmuffs on this. This is just for rainmakers and CEOs of the company, okay? Very, very important. So I had a team come to me, this has been a while ago, and they were 80% buyer income, 20% listing income. And they came and said, hey, we're not nearly as profitable. No kidding, you're not. You're working harder and making less. So the growth opportunity is to really flip-flop those numbers. If you're 80% listing income, 20% buyer income, high five, good for you. The biggest growth opportunity is to really convert some of those buyer leads. Okay. So it's really important. Again, this is just an overview on understanding the numbers and understanding what the percentages mean. So if you're not tracking how much is coming from your sellers and how much is coming from your buyer income, that would be the first place to start. So this is KPI number 1, everybody. KPI number 2 is cost of sale. I could literally spend an hour just in this section to talk about this. Jason Abrams said it best. This was a while ago. 90% of your profit is lost in the cost of sale. And yet, just in my experience, 8 years of being a coach, over 10,000 coaching calls, the majority of teams and agents do not track cost of sale. And yet 90% of your profit is lost through there. Now, what is the cost of sale? 90% of the time or 95% of the time, it's going to be four categories. Four. You get all this information from your DAs or your disbursement authorization. Number one, it's going to be your Keller Williams cap. Okay. Number two, it's going to be your Keller Williams royalty. Number three, it's going to be outside referrals. So whatever referrals that come in, you close them, you pay a referral fee to another agent in an outside market. It's an outside referral fee. And then the last one is going to be team splits. Team splits. Okay. Now you can see on here, you're probably scratching your head and saying, okay, Kyle, what's listing commissions and what's sales commissions? This is outside referrals just broken down to sellers and buyer referrals. So listing commissions is just how much was paid out to a seller referral to other agents to other markets. And this sales commission is what was paid out for the buyer side. Now, the FMLS, I show this because there is some anomalies out there. The FMLS, if any of you on here is from the Atlanta, Georgia area, you probably know what this is. This is, in my opinion, the wealthiest MLS on the planet. They get a piece of every closing of every agent in Atlanta. Okay, so this sample P&L that you see on your screen here, this one team or one agent made or wrote an almost $25,000 check just to their MLS. Okay, it's on here because it's attached to every single closing. Another anomaly out there is concessions. So for example, you're at the closing table, your buyer does a walkthrough and the microwave's broken. They come to the closing table, the buyer's not buying the house because the microwave's broken. The seller says, that's ridiculous. I'm not selling you the house because the microwave is broken. You as agent steps in and buys the $300 microwave. That would be a $300 concession. So that concession would show up right on here on the cost of sale. I've seen E&O insurances, E&O insurance attached to every closing. That is part of the cost of sale. And then any of you that has an ISA or an OSA, an ISA is an inside sales associate, OSA is an outside sales associate, and they get an override, listen to me carefully, an override of every closing, that override shows up on the cost of sale. Their salary or their hourly that you're paying them does not. It shows up under compensation, or you can stick it right there under lead gen because you're hiring an ISA to help find more leads for you. That would be a lead gen source. Okay. What it is not, everyone, it is not photography and it is not staging. Or here's a little bit of a gray area. I want you to write this down. If you're paying a third-party transaction coordinator and they make a certain fee for every closing, I know it makes sense to come on here as a cost of sale. I understand that. This is the MREA 2. Okay, so this is the second version of this. That does not show up under cost of sale. It shows up under compensation. Okay, so that is a gray area where people get confused a lot. So basically, the overall view, everyone, there is no cost unless there is a sale. You teams out here, pay attention to this. Okay, pay attention to this. This is the biggest profit leak that I see with teams and bigger teams in KW. Now, percentages. Let's go back to the MREA budget model. What's the percentage that I asked you to write down for cost of sale? 25%. If you look in the right-hand corner, it's 37.49%. They're out of model. However, it goes back to, are they happy with their profit? If the answer is yes, and they're happy with their agents making money, fantastic. I will tell you, the minute that this jumps over to 40%, 50%, I've seen some teams have 60 and 70% cost of sale. They are just going broke. It is a tough business to be in when the majority of your agents are making more money than you as rainmakers. So this is something that you want to pay attention to. You teams and rainmakers out here, this is also an attrition tool for you. So for example, if you see this team split on here, you can see January through December of 2024 versus January through December of 2023. This first team member made $118,000 last year. Of course, we're just using this as a sample in 2024. and they made $93,000 in 2023. High five. They're making money. This is fantastic. So then you could present that to your team member. But go just the second line down. The team member made $111,000 in 2023, and they've made $70,000 all the way through the point of 2024. Is this team member probably on their way out? Yes. Right. So this becomes an attrition metric to see how your agents are doing, because you're actually tracking that cost of sale or what's being paid out to that team split. Okay. So this is, it's not a red flag yet at 37.49%, everybody. However, it is a yellow flag. Okay. It's a yellow flag. We just got to work on to the next KPIs. So the revenue is number one. The cost of sale is number two. And then we'll move on to the third. Compensation. I saw a question in the chat here. Is compensation, and I've got two slides here. One that shows just the top for staff benefits, and then it kind of works its way down, all the way down to the compensation here. Compensation, everybody, is just your staffing. So it's your runner, it's your VAs, it's your admin, it's your transaction coordinator, anyone that you are paying a salary or a 1099 to. Highlight this and write this down. This is not your salary, Rainmakers. Your salary does not show up here. Okay. It shows up what we call below the line, below net operating income. Okay. And I'm happy to send out a sample P&L if you're curious. I don't know. I guess we can get your information because you had to register. I'm happy to send out sample P&L so you can see, Rainmakers, where things start to fall into, so you can really pay attention to that. But this is not your salary. Your salary does not show up in here. Okay. Staff salaries, benefits, contract labor, professional services. Well, I think somebody said, what's professional services? Bookkeeping, CPA tax, legal fees, right? Would be professional services. Team appreciation. You take your team out there and you buy meals for them, you give them events or gifts. These all fall under compensation. So we're just tracking everything from what your team is. Now, as an executive coach, I'm looking at profit and losses that if I was to buy your business someday. So we set this profit and loss up as if I was to potentially be a buyer. So at some point when you exit the business, you want to have a business that you can show a potential buyer or potential handoff or whatever that looks like. That's for another day. But we want to make sure that we're being accurate with the staffing and the compensation for what your business is run. Now, if you look at the lower right-hand corner, everybody, 15.83%. What is the number that I wanted you to write down? 20%, right? Thank you, Riley. Hey, Riley, good to see you, man. 20%. So now you're thinking, oh, okay, now we're under model. Fantastic. Let's move on. No, this becomes a work-life conversation. This becomes a balanced conversation. Even though you're 4.2% under the budget, this potentially says, who are we missing in our business? Are we working 80 hours a week, you Rainmakers, or are we working 20 hours a week? This becomes a lifestyle potential conversation, because now you know with how you're running your business compared to the best practices, I have some room to potentially hire someone. Is there anyone in our organization? Let's look at our organizational chart and see potentially where we're missing and where we could potentially hire. Okay. This is a really, really good tool when you start to understand that compensation number and start to match that up with your organizational chart or your organizational model. This becomes that conversation around there. All right. I think I got some questions coming in. Send sample, please. Okay. Yeah, I'll be happy to. What I'll do is I'll get everyone information. I'll just go ahead and send you the sample, for that. So we'll get that for everyone from the team. So you're not taking checks and paying taxes like the employees that you are, and your income is just below the line. My accountant put mine in the same category. So if it's a 1099 employee, no, they have to handle their own taxes. If you're running it through a payroll system, compensation, that payroll system will pay the taxes. So money will be drawn out. The taxes for that employee will go off to the state and federal, and then the rest of whatever they're being paid will go back into the account, and you'll pay them whatever that difference is. So the software system, Gusto, ADP, and some of these others, they have the automated system for you to be able to do that. Your accountant probably doesn't know that this is the business model. This is the MREA budget model. So they just don't know to put it below the line. If they're putting your compensation in here, what you see on your screen, that is fine. Well, it's not fine. You're just not to model. However, as a coach, I have to pull that out because I know that's not part of it. We have a certain amount of time together as coaching clients. I want to be able to see your business very quickly. And if I have to pull things out and start to piecemeal things to get accurate numbers, that just takes time. So the model is that your compensation is not part of this. It goes below the line. So if you want to talk to your accountant about putting it below the line, feel free to be able to do that. All right, we'll get recording on this. I think so, Kelly. I think the recordings will be going out sometime over the holiday. I think that's what we have. So again, everyone, this is a very good organizational conversations when you understand what you are paying. When you are growing teams, if you are in growth mode, one of the biggest problems that I see is we do not grow with revenue. We overhire. So then we start to push the envelope 20, 30% of compensation and then expect our revenue. There is sometimes a large lag that catches up to that. The best practice is grow the business, look at the percentage of compensation, factor the math. Can you afford someone based off of the budget model? And then potentially, yes, move forward on that. Do not overhire. You will potentially stunt your growth because you don't have the capital to reinvest. And if that revenue does not come along, sometimes firing someone can be a hard conversation, and you will have to do that at some point if you overhire and not pay attention to that. Okay. KPI number 4. Are we learning something today, everybody? Are we learning something? Yeah, awesome. Love that. Okay, key performance number 4 is lead gen. Lead gen is a really interesting fact because we like to spend money and hit the easy button. Track your lead gen, everyone. Track it. Very, very important. We are in the business of making money. We are also in the business of getting an ROI, a return on investment. If you were to go buy an investment property, you would expect an ROI. Lead gen is the exact same thing. If you're investing back into your business through lead gen, you want to make sure you're calculating this as an ROI. I break this up here into 2, lead gen here, continued, and I bring it back here. This is that listing management perspective of the budget model underneath listing management. So you can see where photography, staging, lock boxes, listing repairs, sign, etc. They all fall under that listing management. So it's a good practice to be able to separate that and make sure that your percentages are in alignment with the budget model. Lead gen completely. All right, so advertising, print, internet leads, follow-up boss, Facebook, like all the stuff here that you can think of that you're investing in lead gen. You just want to make sure you're tracking that. If you look down there in the lower right-hand corner, everybody, that says 4.9%, right? And what did I ask you to write down? Actually, I think there we go. 7.3%. Okay. So 7.3%. I think there's a line that got cut off on this, but this particular sample has 7.4% on it. So it doesn't show, I'm missing a line at the bottom of that. So I apologize. So the total of this is about 7.4%. And what we asked you to write down was lead gen 7.3. Hurrah. Yay. We are within model. Now this becomes a conversation of where I can get more return on my investment or the most bang for my buck, right? So for example, if you see advertising and marketing, you're spending $19,398. Am I getting a 4-to-1 return? I will tell you, everyone, people that I see that are reinvesting back into their business, reinvesting back into their team, their SOI, they're getting an 8, 10. I've seen some teams get a 50-to-1 return on their investment. So really pay attention to this and making sure that you at least get a 4-to-1. If you're getting a 1-to-1, scrap it. If you're getting a 3-to-1 and you see the potential of it and it's growing pretty quickly or significantly, maybe hold on to it. So if a 1-to-1 or 2-to-1, scrap it. 3-to-1, moving into a 4-to-1, maybe hold on to it. However, potentially you could be reinvesting in your business elsewhere. All right, so pay attention to that and see where you can reinvest your money. All right, I'm not a CPA or an accountant. However, here's tax tip number one: meals. The business of real estate allows us the opportunity to write things off, right? Meals is a 50% write-off. So as long as you're using it correctly, as long as you're using it for your business and you're not paying your family's dinner or anything like that, right? We want to really keep it honest. You get a 50% write-off. Now, years ago, I think with the previous administration, I think at one point it was 100%, which was a nice write-off for us business owners. Now it's 50%. The new big beautiful bill, who knows what that's going to happen in 2026. However, as of this point, that is a 50% write-off. So really, everyone, you want to make sure that you're not commingling your personal and your business. You want to make sure that you're running the meals through your business and you're getting a 50% write-off. If you have client events can be write-offs. Separate the meals from that, right? Just separate it because you get a little bit of more of a write-off when you have those meals. So your client events, meals would be one line item. Your client event would be elsewhere for that. So again, that's just an opportunity to write some things off. Tax tip number two, branded gifts versus non-branded gifts. Okay. Brand your gifts, everyone. I think the National Association of Realtor, the law says that we can only give 25% for each closing, right? Branded gifts, Cutco knives, things that have your information on that is a much higher write-off for that. So branded gifts versus non-branded gifts, pay attention to that. Okay. And then the last tax tip here, everyone, is charitable contribution versus sponsorships. Charitable contribution versus sponsorships. And what that means, everyone, is we like to give back. Nonprofit, our favorite nonprofit. That nonprofit comes to you and says, hey, I'd like for you to write a $500 check. And you write that check and you send it to them. Awesome. You do get a write-off. It's anywhere between 6 to 8%. Again, check with your CPA and your accountant on that. However, if you change the conversation and say, Mr. and Mrs. Nonprofit, I would love to give you $500. However, I don't want to write a check. However, I'd love to sponsor an event, sponsor a team, an event, something that gives back to them. However, it's a sponsorship. That's almost 100% write-off. That sponsorship is, right? So it's a win for the nonprofit. It's a win for the business owner, you as being able to do that. So just potentially change the conversations. Again, make sure you run this all by your CPA and your accountant. However, these are just some very simple tax tips that if you pay attention to where things are categorized, you can get some of those write-offs. Okay. All right. We've got a couple more minutes left here, everyone, and we'll start to wrap up. The fifth and final is your net profit. Every single person, every agent, I'm human, I do it too. I want to go to my net operating percentage. That's the first thing I want to go to. However, I walk you through line item by line item because as the CEO, we've got to start looking for red, yellow, and green flags, right? We've got to start being able to take our numbers, understand what the numbers actually mean, and being able to make business decisions from that. Here's just a little overview. I do a lot of studying on P&Ls. I study other industries. I'm just passionate about this. If you are 20% or under, you're in the yellow zone. You want to be, at least for you big teams, you want to be running in that 20 to 25%. If you're over 25% and you're north of that 30 or you're close to that 30, 35, high five, good for you. You have a very solid business. It's just when you start to get under that 20, things get a little rocky. And we all know this industry can go like this. And when your profitability is low on the lower side, you have less margin for error. So you really want to stay north of that 20%. Big teams, I see that 20 to 25. Again, if you're closer to 30, good for you. If you're north of 30, high five. If you are in that 50, 60, 70, 80% profitability range, chances are you have a leverage problem. Okay, chances are. I'm not saying, I'm just assuming. Right. When I look at P&Ls and I see really high profit margins, it's good. Don't get me wrong. You're making money. However, that work-life balance starts to come into the conversation, right? For you solo agents, if you're 60, 70, and 80%, chances are you need to make a higher. You just do, right? You're probably working a lot. You're super profitable. Nice job. How's your family time? How's your time away? Are you able to take vacations from the business, et cetera? So that profit margin becomes pretty critical in that. In the compensation, or excuse me, the net operating income for a million is 39%, right? That's the model under a million. I have seen businesses in that. Just all the P&Ls that I've seen, it's between that 20 and 30% is what I typically see. I'm not saying I'm right or wrong. This has just been my experience in bigger, larger teams. And if you're close to that 40%, high five, you're knocking it out of the park for that. So again, everybody, what I want you to hear from today is numbers do matter, and not just when you're tracking the numbers. However, when you can start to look at the numbers and pay attention to the percentage, and then be able to revert that back to how your business is running and be able to make better business decisions around it, you are on your way to potentially exiting this business, because this is really the first step in understanding how your business operates, is understanding your money. All right, here's a quick snapshot, everybody. This is just another tax rule here. You can take a picture. I'm not. I don't think we're sending out the PowerPoint. These are just things. I am not a CPA or an accountant, right? These are just some taxations that I've received from other accountants. Ask your CPA and your tax advisor, do you qualify for these, right? You can see the information on the right-hand corner. It does not, well, you can read it. Presentation does not and is not intended to, etc. Read that, okay? Again, this is just to help you understand some of the questions that you need to be asking your CPA and your tax advisor. There is a really good book out there. If you like numbers and you love counting, you'll probably love it. If you don't, you might figure out how to pull your fingernails out. However, it's called Tax-Free Wealth by Tom Wheelwright. Tax-Free Wealth by Tom Wheelwright. And I think it's page 261 in the back. And that one page is pretty significant. And that one page says, here's the top 10 questions that a tax advisor should be asking you. And these are the top 10 questions that you should be asking a tax advisor, right? So again, you want to be able to have those conversations. At the end of the day, everybody, taxation is about being your own advocate. You have to be your own advocate when it comes down to taxation. Be educated enough to be able to ask the questions to your CPA and your tax advisor. If they don't understand and they don't know, it might be time to have a second or third opinion on that. All right. So with that, everybody, we're wrapping everything up. Well, we talked about MREA budget model. We walked over what it is and what it is not. We talked a little bit about how to use that. I described the difference between an accountant P&L and business P&L. Both are right, everybody. However, how do you want to be able to use your financials in that? We talked about the cost of sale. I literally could have spent an hour in this. So we did a quick overview on what the cost of sales for you team is. And then we covered the five top KPIs of the MREA profit and loss, and then we wrapped up with some bonus tips. All right, so this is thank you everyone for being a MAPS client. We appreciate the opportunity to serve you. All of our MAPS coaches are super passionate about helping you get where you want to go. So thank you for allowing me to be the first one to kick off this series. And with that, I will go ahead and stop sharing my screen, and I'm happy to open up to the floor for some questions. All right. Come off from mute, everybody. We've got 8 minutes. So if no questions come, then we'll wrap up things. However, I'll stay here as long as the questions keep coming in. No questions?
When will you be sending out a sample of the P&L?
As soon as I get it from the staff, once I get the information, or I can send it to the staff and they can send it out. Yeah. So probably sometime this week.
Kyle,
Anyone else?
is there a way, I'm sorry.
I'll go for it.
Is there a way, if we have a P&L that we can send it in and someone can review it for us and say, hey, you're missing this?
Are we your bookkeeper?
No, I have a bookkeeper, but I'm needing to switch it for 2020.
Yeah, we actually, myself and we have a staff member that has an accounting background that he was an MCA for many years. And so we actually work with our clients on being able to help them make some decisions by siphoning their P&L with them and talk more of a business strategy session, not just a profit and loss session.
Okay, perfect.
Yep. Can you give me an example of a 4-to-1 return? An example would be you host a client party and you spend $3,000 and you get, your average commission is 10 grand and you get 4 referrals from that, right? You paid $3,000 for the client party. However, you received $40,000. That would be like a 4-to-1 return. Now, for compensation for people, it can be a little tough. The biggest thing here, everybody, is to see how much time you're getting back. Time is a value, right? So a little exercise that I like to do, and we can do this right here. It's really easy. Take your salary or your GCI from last year or even this year that you're pacing for, and divide that number by 2080, 2080. And when you do that, that is your hourly rate. So, for example, are you getting enough of your time back that you're paying someone, 1099 or an employee, an hourly rate? So you're getting some of that, your hourly rate back, right? So again, just understanding your hourly rate, that is a way of being able to say, okay, how is compensation? So again, 4-to-1 return on compensation be kind of tough. However, just monitor it, track it. If you're taking some of their jobs back, chances are they're just the wrong hire. They're the wrong person.
Mhm.
Option for coaching without making a long-term commitment. Are there options for coaching without making like a 5-session bundle? I believe there's opportunities. I know MAPS, we've been kicking that around. It's just more specific on training. Coaching's one-on-one, it can be personalized, but there is some group coaching opportunities I think that are coming down the pipeline. Yep.
Mhm.
Yep. There you go.
I
All
got
right.
a
Anyone
question for
else?
you. So let's say you got some new agents on your team, and what would you recommend for them to keep track of, just as an intro to keeping track of the right thing, something simple.
Yeah, that's a great question. A simple spreadsheet, just having them do it every single month, and just really categorizing those 9 categories. Team members, if they want to hire a bookkeeper and they're doing pretty well, all they need is that accountant P&L. They need to track their gross profit, their expenses, and for their net OI. So you're helping them with tax advising. At the end of the day, great question, by the way. At the end of the day, they have to track it, right? And so QuickBooks allows that accountant P&L to be able to do that. So I would put up a simple accounting or just a simple spreadsheet. I have those. I mean, it's just really simple, but they have to just put everything in the month. They have to pull their credit cards, pull their statements, or however they're using that, and then plug that in. Very simple way of doing that. One of the biggest things here, especially with newer agents or people that are just fresh in the business, is they commingle. That would be the first advice. So have them literally stop commingling. Set up a business account, set up a personal account, etc. And then that's one of the biggest thing. And then the second one is start having them have a date with their money. Once a week, they should at least be reviewing their money once a week. And if you're a rainmaker and you're holding them accountable, that becomes a really good attrition conversation because chances are those agents are not getting it from anywhere else, and you could be that resource for them and helping them understand the path of money and how money can help them.
Yeah, I like
Great
that.
question.
Thank you.
Yeah. All right, got 3 minutes. Any more questions? All right. So no more questions. I would like to ask one thing from you is I would love to hear any feedback or any ahas. Would you mind putting them in the chat? Just what did you take away from today? What landed for you? Maybe something that you kind of knew of, but you got more clarity on it coming into today, and how did it bring you value? I'd just love to see some of the feedback if you don't mind. Got a couple more minutes left here before we sign off. Anyone? Did you get anything from today? Profit goal of 39%. Yeah, Riley. Strong appreciation for knowing the numbers and growing your business. Love that. Awesome. Perspective on donations. Need to get organized. Amber, a lot of it. Yeah, a lot of it sometimes just being organized, just spending some time. Have a date with your money. I love that. Thanks for being honest and vulnerable. Difference of profit and loss, P&Ls. Yeah, difference between look. Yeah, that's great, Jillian. Awesome. Okay. Well, everybody, it sure is an honor and a pleasure to be with you today. Thank you for allowing me to be an hour of your day today. This really is my passion, is to empower agents to financial freedom. So if you grab something from today that really helped you, fantastic. Then it was worth the time today. And as always, if there's any questions or need anything, I'm always around and always available to you. So thank you so much for being a MAPS client. We appreciate the opportunity to serve you. Have a wonderful holidays, everyone. Appreciate you. Take care.